basically we discuss about last week we discussed about various risks that financial institutions face or get exposure to. Today we are mainly going to discuss about market risk, and as I mentioned, there are few categories of market risk, or you can say few sources: interest rate, foreign exchange, stock market, and commodity prices. And again, in this course, especially since Sri Lankan banks are not that much exposed to stock or the commodity, we'll mainly focus on the interest rate and the foreign exchange risk. We'll start with the interest rate risk. Last week I explained what is interest rate risk. That is the risk that rising due to the interest rate changes in the market. Market interest rate change for various reasons. It may be due to policy rate change. Central bank changes the interest rate policy interest rate, or it may be economic factors, other economic factors based on that market participants they expect something else, and the term premiums and all those things matters when we consider about the interest rate. We discussed that at the very beginning, what are the components of interest rate. So for whatever the rate change or the component changes, the interest rate change. When the interest rate changes, prices or the value of financial assets, most of the financial assets, especially interest rate sensitive assets or and liabilities, value changes. So when that happens, balance sheet will have an impact, or the profit and loss will have an impact. So we are going to discuss today how do we measure that, because it is a risk. It may be a opportunity or it may be a loss when the interest rate changes. So we are going to discuss how do we measure it, and later we'll discuss how are we going to mitigate that risk. First thing what we have to identify, in a bank there are two books, we call it banking book and the trading book. What is the banking book? Any idea? What is the banking book and what's the trading book?
The banking book has the assets that the bank is intending to hold, and trading book is the one that has the trading assets.
Yes, correct. Banking book is the it comprises of assets which are or the bank expect or wish to hold until maturity without reselling it or doing frequent buying and selling. The bank wants to hold those assets until maturity. So most of the loans and other facilities provided by the bank fall into this banking book. In contrast to the banking book, trading book is the turnover is high. You do lot of transactions. You buy assets into that book or you sell it from that book. So most of the government securities, sort of liquid assets, mostly keep it in the trading book. with the intention to trade and make a quick profit when the market prices changes in your favor. With the market movements, you do buy and sell transactions the to get the difference as a profit. But in the banking book, you mostly concentrate on the interest income. So you hold the asset and you earn the interest. So the basic purpose of the bank holding the banking book is to get a long-term interest income, whereas the trading book is to get a trading profit or a capital gain. So therefore, the risks that we face in the banking book and the trading book is slightly different, even for the interest rate risk. So in the banking book, refinancing risk and the reinvestment risk are there. What is refinancing risk? Whenever your asset matures, sorry, whenever you invest for a longer period or you hold a long-term investment, you have to fund it because you need funds to maintain that investment. So what is that funding cost? If you want to do it in a very frequent manner, generally that's the case in a bank. You buy long-term assets with the liabilities or borrowings in the short run. So therefore, if you want to hold the assets, long-term assets without liquidating it, you have to borrow repeatedly or in frequent intervals. What would be the cost of that borrowing? That is refinancing cost. So the risk is if interest rate goes up, your refinancing cost will increase. Then your net interest income will go down. That is the refinancing risk. Then the other thing is reinvestment risk. Whenever asset matures, you have to reinvest that cash flow. By the time, if the interest rate has gone down, your reinvestment would be at a lower rate. Then your interest income may go down. Now you can see in the banking book, two different risks, refinancing risk and reinvestment risk, that becomes when the market moves in two different ways. Refinancing risk arises when interest rate goes up. But on the other hand, reinvestment risk arises when the interest rate goes down. So therefore, there will be a loss or there's a risk either way, whether interest rate increases or interest rate decreases. Either way, you get a loss or there's a risk. So therefore, when you decide the balance sheet, the trading book, which tenor that you are going to invest, which sectors, so then you have to think about what would be the future interest rate movements. So basically, you decide the strategy and you take the positions based on that. In the trading book, it's the value of the investments will change very frequently when the market prices changes. Therefore, you need only a very short term, maybe few months or 1 year interest rate forecast. You don't think about more than that in the trading book. But in the banking book, it's not the case. You have to think about maybe 10-15 years ahead when you take a strategy. In the trading book, we discussed last week as well, all the assets we mark to mark, do mark to mark in very frequent intervals, if possible, daily. But there's a cost. You need market prices and you need a process. So there is a cost. It is also substantial in some markets. With that trade-off, considering the cost and benefit of doing mark to market, trading book is mark to market at in frequent intervals, which we don't do generally in the banking book. So doing mark to market, we can know whether trading book gives us a profit or a loss. When interest rate increases, we know value of rate sensitive assets goes down. So your value of your portfolio goes down, incurring a loss. So that is the loss or the risk that we face in the trading book with regard to interest rates. So when interest rate changes through this trading book and the banking book, the impact can be twofold, we can say. First one is net interest income. When interest rate changes, it will affect the net interest income of the bank. What is the net interest income? How do we define net interest income? What is the definition of net interest income? Or how do we calculate net interest income?
Interest income minus interest expenses.
Yes, in a bank, there are interest income as well as interest expenses. What are the interest income? What are the sources of interest income?
Interest from loan interest.
Loan portfolio, yes. What else?
Treasury bills bond.
Investments in treasury bills and bonds. What else? Maybe reverse repo transactions like call money placements in the market, small short period deposits with other institutions. You may earn a income with the money you park overnight with the central bank. So likewise, there will be many interest income sources, or maybe on credit card payment, credit cards, like that. What are the interest expenses, or what are the sources of interest expenses? What are the sources of interest in expenses?
Loan.
Loan and advances obtained by the bank.
Loan and advances by the bank. What does it?
Deposits.
Deposits, yes, the deposits that the bank has taken, yes.
Borrowings
Borrowings,
from
maybe
other institutions.
other institution, yes, maybe through the call money market, or in the money market, the bank may have borrowings for short period, maybe from the central bank. So for all those, you have to pay the interest. Those are the interest expenses. Basically, interest bearing assets will give you interest income. Interest bearing liabilities gives the interest expenses. So the difference within whatever the period, within a 1 year or 1 month, the difference between interest income and the interest expense is the net interest income. So when we calculate or talk about net interest income, it should be for a specific period. It's a flow. What is economic value of the portfolio? earlier I mentioned that trading book we do mark to market. What is the current market value, and compared to your cost, it will give you a profit or a loss. But we don't do that in the banking book. But still, there is an opportunity cost. If you have borrowed at, say, in Sri Lankan context, if we think you borrowed a few years back, say 2000, say 17, 18, for a 5-year period, you have taken deposits. What would be the interest rate? Few years back, maybe 2-3 years back, what was the 5-year interest rate for deposits? Any idea? What was the interest rate that you agreed to pay for a 5-year deposit?
Say 15%.
Say somewhere, yes. Maybe it may be less than that, around say 13 to 15%. But now where is the rate?
That's 5 to 6%. Okay.
Yes. Now even if say the 5 to 6%, I think for 5 year, maybe.
8%.
Yes.
So what is your opportunity cost there? At least say now we discussed that 15% is say 3 years back. Now remaining period is for that deposit is only 2 years. For 2 years, what is the interest cost for the bank now? It is less than 5.
Same rate.
Yeah, okay, say 5%. Now, but you pay at 15% for the same deposit which you take 2 years or 3 years back. For the next 2 years also, you have to pay 15%. Whereas you could have borrow it at 5, somewhere around 5%. So there's a opportunity cost. In the traditional accounting, you don't see that. In accounting, you don't see that. You what you incur or what you record in the accounting, your interest expenses at 15%. So that could have come down or brought down to 5% if it was not the case. That is from the liability side. From the asset side, the other way around, that can happen. That means when you invest for a longer period at a lower rate and subsequently interest rate increases, what happens? There's opportunity cost again. You earn a lower income compared to the higher interest rates. So capturing all those things, that economic value of the portfolio is decided. So therefore, we assess the impact of interest rate risk on net interest income as well as the economic value of the portfolio. So we will see how do we do this. There are two methods: gap analysis and duration analysis. I think you know how to prepare a gap report, or how to do a gap analysis. When you have what are the steps that you have to follow? First, think about what are the time buckets that you want to use. Then how do you place your assets and liabilities into different buckets, whether you put the maturity value or the current market value or the contractual value, or with the or only the interest income, or not the without the interest income, or how do you do that? I guess you know about it now. And whether you consider the original maturity or the remaining maturity, or the when the instrument is at a floating rate or variable interest rate, whether you use the original maturity or the repricing frequency, when you put those assets and liabilities into different buckets. Now I assume you know that because you discuss it at the ALM module. So that's one way of assessing the impact of the net interest income. Then the other one is the duration analysis. How do we do the duration analysis, and how do we measure the impact on the net interest income? So we'll discuss these two. Probably we will be able to finish it today. I think we should be. So this is just to recap of income gap analysis. This is a very basic concept. Sometimes some banks may not use nowadays, but small banks maybe yes, still they may use this, but there are more sophisticated methods, especially using the duration analysis. And either way, whether you use gap analysis or is duration gap analysis, there are pros and cons as well. Basically, what is the gap? If we define the gap, the gap is the difference between rate sensitive assets and the rate sensitive liabilities. What does it mean by the rate sensitive?
Change very quickly.
When the interest rate changes, there will be an impact on the asset or the liability. The cost or the income changes. That is the rate sensitive, which means. So rate sensitive assets are sensitive to the interest rate changes. Rate sensitive liabilities also sensitive to the interest rate changes. So what is a positive gap? Whenever we have more rate sensitive assets than the rate sensitive liabilities. So this difference is positive. RSA is higher than RSL, then it's a positive gap. Then negative gap is whenever we have more rate sensitive liabilities than the rate sensitive assets, then it's a negative gap. That means the difference is you get a negative figure, minus figure. What does it mean?
So it means that you have enough assets to pay your liabilities.
When?
If there is any demand or maturity.
Oh, I mean, when do you have enough assets to pay the liabilities?
In the positive gap.
In the positive gap. Yes. There are more assets maturing than the more liabilities maturing in a certain or a specific time bracket. So then you can meet your liquidity requirement. You can pay. Why do we now here? We are mostly worried about the interest rate risk, not that liquidity requirement. That's why we use only the rate sensitive assets. For the liquidity, we don't consider whether it's rate sensitive or not. There can be cash flows or the assets which are not rate sensitive but gives you a cash flow, then you can use that to pay your debt or your liabilities. In the liquidity management, liquidity gap, then you have to consider that as well. But here you don't use those sort of assets or liabilities which are not rate sensitive. So here we mostly focus on the what would be the impact on the net interest income. So therefore, if the interest rate changes, interest income or the interest expense should change. What would be that? That is what we are going to assess. So whenever we have more rate sensitive assets than rate sensitive liabilities, what would happen if interest rate increases? So what does it mean by we have more rate sensitive assets than rate sensitive liabilities? What do you feel?
NIM will reduce.
NIM
Will
will
reduce
reduce. Why?
because the liabilities will immediately reprice.
When we have more rate sensitive assets than the rate sensitive liabilities?
The repricing of liabilities faster than repricing of assets.
When we have a positive gap,
Yes.
what does it say here? RSA exceeds RSA. So that means rate sensitive assets are high. Amount of rate sensitive liabilities are low. Then what would happen? What does it mean? Any other answers?
When we have rate sensitive assets than rate sensitive liabilities, our interest income is higher than the interest expenses. So that is
Why?
favorably
Why?
because when we have rate sensitive assets, our interest income is goes up, and when we
Why?
have interest
Can you
the,
explain
the,
how that can that happen?
when interest rate increases,
Hmm.
uh, we have positive impact to the profit,
Hmm.
and when
No,
interest rates
yes,
go
true. No,
down,
my question is
yeah,
how could that happen? That means when interest rate you have a positive gap and the interest
yeah,
rate increases, you know
yeah,
what you say, you will get more interest income.
yes,
How?
because
How? Yes,
uh,
go on.
when the gap is positive, that's
Mhm.
mean our interest income is higher than the interest expenses. When
No,
interest
this is
rates
this is
increases,
no, this is not the difference between interest income and the expenses. This is the amount of assets, interest bearing assets we have. These are the
yeah,
interest bearing liabilities we have. We have more interest bearing assets than interest bearing liabilities. So how, when the interest rate increases, our interest income or the margin improve? Can you explain that point?
So you can reinvest it at a higher rate, sir, shortly.
Exactly. That's what happened. Because say if you take today, if you have more assets, if you have more assets than liabilities, so you may have to roll over both. That means investment you may have to reinvest, liabilities also maybe you may have to regenerate. Or if not, in the best case or the worst case, whatever it is, what do? You set off all the liabilities, but still then you have some excess funds where you can invest. You invest that at a higher rate. Then your interest income increases compared to the previous period. That what would happen. That's why when we have a positive gap, if interest rate increases, our interest income increases. Is it clear? Ultimately, you will remember it like when the gap is positive, interest rate increases, net interest income increases. That's correct. But how and why? That you should be able to explain that. If you know that, you even though you forget about what would happen, you can derive that answer. Is it clear? Why we will get high interest income when the when we have a positive gap? Is it clear? Tell me whether it's clear or not. Either way, we can move forward.
Clear, sir.
It's clear. Okay. So then tell me, when the gap is negative, what would happen when the interest rate increases and why?
So the same thing would happen, right? When the interest rate increases, your you'll have to roll over your liabilities faster than your assets, and your interest expense would increase. Right?
Yes, that's what happened. You have more liabilities to meet. Then what would happen? You have to generate new liabilities. Those new liabilities will be at a higher rate because interest rate now has gone up. Then your interest expenses increase. So that's what happened. So in this table summarizes it. Whatever the name that we use, positive gap, or we can say it's a asset sensitive balance sheet. That means assets are repriced very frequently. So the your interest income sensitive to the assets. Or the other one is negative gap, that is liability sensitive. That means liabilities are repriced at a more frequently or at a higher frequency. So that's what happened. When do we get that positive gap is when you have short-term assets funded with long-term liabilities. You have short-term assets funded with long-term liabilities. So basically, you have to roll over your assets. When an asset matures, you have to reinvest it. By the time you reinvest it, whether interest has gone up or gone down, that will have an impact on the interest rate. Interest income. On the negative gap, long-term assets are funded with short-term liabilities. So you have long-term assets. That's the more probable case, especially in a bank. You fund long-term assets with short-term liabilities. Then whenever interest rate changes, your new liabilities will be at the new interest rate. So if the interest rate has gone up, your interest expenses increase. If the interest rate has gone down, your interest expense goes down. So that's what happened. That effect is explained in this third row. When you have a positive gap, if interest rate increase, net interest income increases. If interest rate decline, net interest income decreases. Whenever you have a negative gap, that means you have more liabilities than asset. When interest rate increases, NII reduce. Whenever interest rate decreases, your net interest income increases. So that is the basic idea. So we'll go through an example and see how do we calculate now what would be the impact of the on the net interest income for a given balance sheet. So the balance sheet is given. There are different assets and different liabilities. Just go through these and try to identify what are the interest rate asset sensitive assets, what are the interest rate sensitive liabilities, and what are the things that we may have to put into different buckets. I'll give you 1 minute or two. Just go through and try to identify what are the interest rate sensitive assets and what are the interest sensitive liabilities. Physical capital, that means physical assets. Is it rate sensitive?
It's not rate sensitive, right?
It's not rate sensitive. Okay, residential mortgages, fixed rate for 30 years. Huh?
Fix is known as
No.
Fixed is not. But in a gap analysis, where would you put this? Or you don't put into a particular bucket? What do you do? Will you place this 12 million or whatever it is into a particular bucket, or you don't put it at all? What is your answer? Fixed rate 30 years residential mortgages. In the gap analysis, will you put it into a particular bucket or no? So that means you completely ignore it. So in other words, do you treat both this fixed rate 30-year residential mortgages and physical capital in the same manner?
known as
No. Then What is the difference?
It should be funded through long-term assets, not
Which one?
sorry, liabilities. That
Which one? Which one?
30-year loans.
Okay, that true. No, I mean when you put these assets and liabilities into buckets in a gap analysis, what do you do with these fixed rate 30-year loans, mortgages?
To put it to a long remaining bucket, remaining maturity bucket.
Yes, if you have any bucket which covers 30-year period, you should include that this 12 into that bucket. But this physical capital,
It will not.
it will not. You won't consider this in the gap analysis. So if we take liabilities, is there any liability that you won't consider in the gap analysis?
That checkable deposits.
Checkable deposits, you don't consider it in the liabilities. Why?
It's not related to any interests.
It's not related to any interest. So if you are not bound to pay any interest on these checkable deposits, you don't consider it. Correct. What else?
You won't consider the bank capital, right?
Sorry? Yes. You don't consider bank capital. You don't pay any interest on the capital. That's the basic. Okay. Now think about just a 1 year period. Forget about all other buckets. Assume 0 to 1 year is the period. Now you want to measure or assess what would happen to the balance sheet, or what would be the impact on the net interest income. Sorry, not on the balance sheet. What would be the impact on the net interest income? So you are going to do the assessment. So what are the rate sensitive assets and what are the rate sensitive liabilities that you have to consider in this scenario? Just think about it. What are the rate sensitive assets that you have to consider in this scenario?
Securities that is less than 1 year.
Securities less than 1 year, because they are maturing within a 1 year period, then they are rate sensitive. If you are to roll over, that means reinvest, you have to invest at the new rate. Anything else?
Residential mortgage that is coming under variable rate.
Residential mortgages coming under variable rate, assuming the frequencies or reset frequencies less than 1
year.
So whatever fall within next 1 year period. Anything else?
Commercial loans that is also under less than 1 year.
Commercial loans less than 1 year. They are maturing within 1 year period, then you have to reinvest. Anything else? So generally this is whatever you mentioned are correct, but apart from that, especially in the mortgages, there's a prepayment facility or possibility. If the borrower thinks, I don't want to pay this mortgage for long, and now I can settle it, then they will come and settle it, or maybe at least partly. So therefore, the bank should have an assessment on that, even in other, if possible, commercial loans, if possible, if there's any possibility for the borrower to come and prepay at least partly on their borrowings, then bank should have an assessment what is the amount of what sort of a proportion there will be prepayment that has to be assessed. So bank has to think about it and have some policy on that, how to what is the proportion of prepayments within a 1 year period. So if you think that there is some significant amount there, then you have to consider that as well. So in this example, as you mentioned, less than 1 year securities, residential mortgages with variable rates, and commercial loans less than with maturity less than 1 year. All these three assets are eligible to fall into the less than 1 year bucket. So apart from that, in this case, I have assumed 20% of residential mortgages also to be considered because there's a chance of prepayment. So this is not a fixed thing, that 20%, depending on your experience or an analysis of historical data, or assuming or based on your interest rate forecast. So say, so when would be the bank gets more prepayments? When the interest rate is high or when the interest rate is low?
Interest rate is high, no?
You get more prepayments. People tend to pay early.
You mean say that other than contractual payments, no?
Yes. So they want to, the borrower wants to settle it early without waiting for the whole period.
When loan rates are in high side.
When the interest rates are high, people want to settle their loan early.
Also, interest rates are low.
Interest rates are low. Why?
Because they can obtain the loan for a lesser rate from other institutions.
Yes, that's what happened. When the interest rates are low, even on the existing loan, there may be a penalty for the early settlement, but still there in the long run, it may be worth. So they will go for a new facility and uh, settle the existing facility. That can happen. So that happens when the interest rates are low, and not only low, then they think it is sort of a bottom. So to assess this, the interest or the path of interest movements also important, whether it has come from a high level to a low level and again now it's picking up. At that point you would see a lot of prepayments. Even the interest rates are low and hanging there, they may not be that much of prepayments, because if people think interest rate can go further down, but whenever they think now the interest rate is going to go up again, there will be pre-settlement. So
That's only for, I think, fixed rate loans, no?
yes,
Variable rates, that
if it is a variable rate, no, even it's a variable rate, what would happen?
then as per the market rate, it will be changed, huh?
No, what do you do when you have a floating rate borrowing? Say your floating rate is say set every 6 months. Now interest has come down to a bottom. Now you think again interest rate is going to go up. What do you do? as a rational thinking person, what you should do. You have a variable rate borrowing. Now you think interest the rate at the bottom and going to go up. What do you do?
Fix the rate at lower
Fix.
market.
Yeah. Get out from the floating rate borrowing and fix the rate at the lower rate. So then what would happen? You will get prepayments. So those are the things that you have to consider and come up with a estimate for these sort of prepayments, and if they're based on your balance sheet or instruments that you have in your balance sheet, these sort of other rate sensitive assets. So you have to consider those. That's the key message that you have to take. It's not only the obvious ones. There can be some other things. So in this example, I assume 20% of the mortgage, residential mortgages will be prepaid. So altogether, amount of rate sensitive asset fall into the 1 year bucket, less than 1 year bucket is 36 million plus 20% of this. So when we add 6, 12, 18, 18 plus 18, 36. So this 36 is there. Then residential mortgage, 30-year amount is 12. 20% of that is 2.4. So 20% of this is 2.4. Altogether 38.4 million. Now think about the rate sensitive liabilities. What would be the rate sensitive liabilities?
Money market deposits,
Money market deposits,
then savings deposits,
savings deposits. So basically in this you can see this again, saving deposits depending on your if I have not considered here whether you pay interest for that and whether you how quickly you change that. Even the interest rate changes, how quickly you change the interest on the saving deposits. Okay, if you go back or come back to the Sri Lankan scenario, now last 2-3 weeks back, central bank increases the policy interest rate. How many banks in Sri Lanka increases the saving deposit rate? Have you done it? Even the fixed deposit rate, have you increased?
no,
No.
no.
No. So that's why. So that how you have to assess that stickiness as well. So in this case, I have not considered even savings deposit. So remember, these are not exhaustive or list what I have considered. Depending on the situation, market, and your experience, you have to include or exclude things. But you should know what are the things that you have included, what are the things that you have not included, then what would be the repercussion, whether those exclusions can give a material impact or not, whether they are significant or not. So that has to be there. So basically these things has been considered in have been considered. Anything else that you think we have to consider?
Sir,
So that
excuse
will
me.
Yes.
Yeah, sorry. Sir, excuse me. Savings deposits normally go to less than 1 year bucket, no, because it rolls over frequently. Since it rolls.
Yeah, not it because of the yes, rollover means how frequently you adjust the interest rate for savings. That's what you have to consider. So that's what I mentioned. So this is not the liquidity assessment. For liquidity, you have to think whether savings deposits, what proportion of savings will go out during a 1 year 1 year period. So if you think saving say 50% of savings are going out within a 1 year period, then for the liquidity purposes you have to put that only 50% in the one year bucket. Others you can put it into the longer buckets. But here it's not the case. Here what you think about the interest rate. So if you think still if you think 50% of deposits will be taken out, then only 50% of deposits will be repriced at the new rate. If you think interest rate change tomorrow and we are going to change the interest rate for the saving deposits by tomorrow itself, then the 100%. So likewise, you have to come up with your own mechanism whether you should include it or not. Did I answer your question?
Yes, sir. That based on assumptions.
Assumptions, or you are not, it's kind of assumption, but based on basically maybe your historical information or data, and based on that analysis you have to come up with a estimate.
Okay, sir. Thank you.
Someone else also tried to ask a question, I think, or give a comment.
So that what does mean that federal fund? That is means
Yes, that's what I
similar to
yeah, this is like in Sri Lankan
CBSL funds,
no, call money,
SDF or
call money,
hard money, right?
yes.
Normally, sir, in a banking sector, then if any interest rate hike, that very first repricing will happen in savings deposits, no?
Savings deposit.
Yes.
So you mean you very quickly change the interest rate for savings?
Mostly that is the behavior, no? Not the fixed deposits. Because to
Yeah.
maintain the CASA base, that is the
Yes,
most priority area.
yes, that would be the case. Again, that depends on what is the bank's view and the competition or the liquidity position as well. So we cannot think all those things in isolation of one factor. We have to look at the picture, or the macro. You have to get the macro view. What is your liquidity position? What is your, or the what is the economic condition? What is your view on interest rate? What other participants in the market they do? So if you want to keep your customers, then if say when others are increasing interest rate, you cannot wait. So then you have to attract deposits. You have to increase interest rates. All those things matters. Yes. So yes, since you have more flexibility in a savings, say you increase the interest rate, then the next month again interest rate goes down, then again you can change the interest for the saving deposits. Therefore that may be the one you change quickly. But in the fixed deposits kind of thing, once you fixed, you cannot change it. So therefore you will wait until you see a firm direction in the interest rates. That can happen, but I think before the savings rates, you may change the other side from the asset side. I think that's the side you change first.
Yes, sir.
Normally, banks increases loan rates first, no?
First, yes. Shall we move forward? So again, the checkable deposits here I have assumed 10%, or I took it from a book, if I remember correctly. So again, as I mentioned, say 20% of savings deposit. These things are the obvious one, but as we discuss, saving is something subject to even the checkable deposits, something we may have to consider. That depends on if you're pretty sure for checkable deposit there's no interest payment, nothing, then you don't have to consider. But for some reason, if there's any chance that you pay some interest, say if the balance is above some threshold value or something like that, you pay at least for that portion, things like that you have to consider. It's not only the very straightforward things. That's the key message from the asset side and both assets and liability side that you have to remember. The obvious ones are clear, but think about others as well, whether there will be any impact. Here I have assumed 10% of checkable deposits and 20% of savings deposits, and these obvious things: 6 plus 12, 18, 36, 42, and 54. So that 54 million plus 10% of checkable deposits, 1.8, and 20% of savings, 3.6. Altogether it comes 59.4 million. Now we have the rate sensitive assets, amount of rate sensitive assets, and the rate sensitive liabilities within a 1 year period. Remember that this is only for the 1 year bucket. We are going to assess it. So what is the gap? Gap is the rate sensitive asset amount minus the rate sensitive liabilities amount. So the asset was only 38.4 million, whereas the rate sensitive liability amount is 59.4 million. So therefore there's a negative 21 million. There's a gap of negative 21 million. Now it is very easy. If interest rate increases immediately by 1%, that's the other key. We assume the rate change immediately. The rate impact will be immediate. If interest rate increase by 1% today, and for all the above products that increase is going to apply, then what would be the change in interest income?
Sorry, sir. When we did the calculation, we assumed that the rate is going to increase, right?
Yeah,
As
here,
to the
here,
prepayments and all. If
yeah,
it is
yeah.
going to decrease, you'll have to do a different calculation. Is that
Not necessarily. Let's see.
okay?
Say okay. Instead of saying increase here, if I say change, what would happen? This is no longer there. This sign is no longer there. 21 million is the gap. That is the interest rate sensitive part of our 1 year bucket, because both the other parts are get set off each other. There's an excess amount of 21 million. If interest rate changes by 1%, what would happen? Our interest amount change by 21 million into 1% for a 1 year period. We assume for a 1 year, within a 1 year, so 1 year period. It becomes as 0.21 million.
So when you arrived at this 21 million figure, if you go to the previous one, you will see the prepayments that you assumed that this prepayment will happen because of the rate increase, right?
No. Not because of rate increase. So
okay. So yeah, you're assuming anyway this is going to happen.
Anyway, this is going to happen.
All right. Okay, thanks.
Mr. Nishant, that is basically the percentage component that you marked is like a, I mean, what do you call it? A proportionate.
It is your assessment.
Assessment.
Yes. Yes.
Also,
it's an estimate.
Estimate basically,
Yes.
And also when you consider for the calculation, we consider only the capital amount, no?
Yes.
Okay.
So now, whenever we have 21 million at exposure, and the interest rate change by 1%, our interest income will change by 0.21 million. Is it correct? This figure, because 21 million into 1% is only 0.21 million. So now you know you have more liabilities than the assets. Then if interest rate increase, what would happen? Your interest income will decrease by this amount. But if it is increase, but what would happen if interest decrease? You have more liabilities. Then interest income will go up by the same amount. The amount won't change whether it's an increase or decrease. Only the direction change, whether interest income is going to go up or go down. Is it clear? So in this case, I have considered only the interest increase scenario. Then it's easy to put this or go with this sign. Since this is interest rate increase, this is a plus 1%. If it was a interest rate decrease, then it should be a minus 1. Then the answer would become a plus 21 million. That means your interest income increased by 0.21 million when the interest rate decreases. Is it clear?
Yes.
So what is the amount at risk? And apply the interest rate change, you get a quantity. Then you can decide whether it's a positive change or a negative change depending on your position and the change in the interest rate direction. Any question?
Sir, when we calculate this, can't we consider that time to maturity? Don't we have to consider?
That way we use when we do the bucketing. That's what I mentioned. So here we consider only 1 year period. So whatever the time buckets you have, you prepared in gap analysis according to your requirement or which suit for your balance sheet. Whenever you place these things, you have to think about. So even here I mentioned fixed rate 30 year. Now what we assume is all 12 million is still there's a 30-year maturity period, but there may be loans with maturing different time frame. Originally mortgage is for a 30 year, but with the time those have come down to remaining maturity. Some may be 5 years, some might be 10 years, 12 years, 7.5 years, something like that. Then depending on the remaining maturity, you have to place those into the proper bucket. That is, you can do only if those are at a fixed rate. If those are at the variable rate, then you don't want to think about the remaining maturity, but you have to think about the repricing maturity. When you are going to reprice this mortgage? Say repricing maturity, repricing frequencies every 6 months. But now when you prepare the gap report, 3 months have gone from the last repricing. Then where do you put it? You have to put it into the 3-month bucket, because within next 3 months that will be repriced. So that all those concepts that you learn in gap analysis, how to bucket, that you have to apply here as well. Any question?
So that means that is not in case of the less than 1 year we do not consider. That means variable rates. It is only variable we consider. See?
That depends again. Here this is only example 1 year period. So therefore, whatever less than 1 year we considered as one bucket. So therefore, all those things we put it into that bucket, less than 1 year. And apart from that, assuming or with some assumptions, even this fixed rate bonds, 20% of this fixed rate mortgages, there will be prepayments. So we included that as well. If you have some experience or possibility, even this commercial loans 1 to 2 years or greater than 2 years, there can be prepayments. You have to consider those as well.
So that means depending on our assumptions, we can include those.
Yes, depending on the assumption, but assumption should be realistic. So if you don't have any clauses in the commercial loans that they can prepay, then it won't happen. If it is not allowed in the agreement, they cannot come and say, okay, no, I want to pay it this. It is not going to work. No? Then you can't do that. Take it as an assumption, whether it's permitted, whether it's happening, that you have to consider.
And this is done depending on the historical data.
Either way, you can, without considering the historical data, if you can come up with a forecast. What we need is an estimate. How do you do that estimate? Again, depends. You can go just by a rule of thumb. You assume some fixed rates. You use that, or you analyze the historical data. You just apply the same percentages into the future, or you forget about all history. You have a good model to forecast just the future, come up with that. Or it may be a combination of historical data. You analyze historical data, but the future may be different. What you can do, you make a small adjustment to the historical data to suit the coming period. So it's up to the bank to decide what to do. Again, depending on the cost benefit analysis. If you are going to use a very sophisticated model, there will be a cost involved. Depending on the products that you have and the difficult or characteristics of those products, complexities of those products, you can decide whether we need this sort of sophisticated method, or whether we can go by a simple method, saving on that sophisticated systems and methods.
Okay, sir, I have another one. That economic value of portfolio, that do we consider both trading book and banking book, both of?
Trading book, basically it is reflected, because when you do mark to market, if the say for an asset, when you do mark to market, if the interest rate has gone down, market value has gone down. So that loss is your opportunity cost in a way, sort of. So you immediately recognize that in the P&L. So that is captured there, but mostly it is to the trading book. I would say in the mostly to the banking book. In the trading book, it's already happening, more or less.
Okay, sir, thank you.
Anything else? Okay. So in this, what do we assume? So what are the assumption is, say, since we are going to assess for a 1 year period, if we do this calculation, but these assets and liabilities may be maturing in different times during this 1 year period. So if an asset matures here, then it will be repriced at this point, and only the new interest rate will be applicable for this period. There may be a liability which is maturing here, then the new rate will be applicable only for this period, likewise. So individual assets and liabilities timing may be different, but here if we use this, what is our assumption is everything matures here and roll over here. So therefore the new interest rate will apply for the whole year. In a way, this is a very conservative approach in this scenario, because you have a negative gap. So that is something you have to identify. So practically, this can be considered as the maximum impact. But what would happen in reality, impact would be less than that, again depending on the where are the maturities and liabilities. Definitely it will be less than that, because even a liability matures here and asset matures here, you pay this much for the liabilities and for this period for the asset, something like that. There will be time differences, but this is the maximum. So therefore you have to have that understanding. This is a weakness. This is a very simple method. So simple methods comes with some weaknesses as well. So that you have to something that you have to remember. So in summary, we can put that into a formula, mathematical formula, saying net interest income change by an amount equal to the gap into the change in interest rate. So what is the gap amount, and multiplied by the change in interest rate. If the gap amount is negative, it would be a negative amount here. If the interest rate change is positive, it would be a positive amount. So the change in interest income would be a negative figure. If both these are negative, change would be a positive figure. If both positive, would be a positive figure. So likewise, with the sign, if you substitute gap and the change in interest rate here, you get the change in interest income with the sign. That means whether interest income will increase or decrease. Not only the quantity, you get it with the sign. So in summary, this is the relationship between gap position and the impact of the net interest income depending on the interest rate movement. So what does this arrow reflect? When you have a positive gap and interest rate increases, your net interest income increases. When you have a positive gap but the interest decreases, then your net interest income will decrease. What is this? You have a negative gap, interest rate decrease, so your net interest income increases. Whenever you have a negative gap but the interest rate increases, so your net interest income decreases. I think no need to remember this, even though this is the summary, no need to remember this. But the best thing is to understand what is a positive gap and what is a negative gap. Then you can decide what would happen whenever there is a rate increase or a rate decrease. Then again, this is another example with few buckets and with the already prepared gap report. So 0 to 3 months, 4 to 6 months, 7 to 12 months, and over 1 year. There are just only 4 buckets. These are the amount of assets fall into each bucket and the liabilities. The difference is the gap. In the first bucket, there are 100 assets and 200 liabilities, so the gap is negative 100. In the second bucket, 150 assets and 200 liabilities, the gap is only 50 negative, more liabilities. But the cumulative gap, first bucket, it is same as the gap in the bucket, but in the second bucket, it's the previous bucket gap and the gap in the current bucket. So these two, you add these two together and you get this 150. In the third bucket, again, there are assets only 200 and with 400 liabilities. So the gap for that bucket is 200. Then the cumulative gap is 350. 150 plus 200, it's 350. Over 1 year, there are more assets than the liabilities by 350 amounts, exactly opposite of this. So therefore, cumulative gap becomes 0 at the or after 1 year period. So basically, less than 1 year, the bank is having a negative gap. What is the risk? What is the risk on the interest income? When you have this kind of balance sheet for the gap report, what is the risk?
Going up.
Going up what?
Interest rate.
Yeah, the risk is if interest rate goes up, what would happen? Your net interest income goes down.
No.
So to limit that risk, generally there can be some limits imposed on the gap. So these are the limits given. It's based on the cumulative gap, not on the gap. It's on the cumulative gap as a percentage of assets, not on the absolute figure. Because depending on the size of your balance sheet, absolute figures may become very big but as a percentage it may be a very small. So therefore generally we use some sort of a ratio. In this case, the example in this example, it is considered cumulative gap as a percentage of assets as the risk measure. So in the first bucket, cumulative gap is 100, total asset is 1000. So therefore, the ratio is minus 10%. In the second bucket, cumulative gap is 150, total assets 1000, 150 divided by 1000, it gives us a minus 15%, likewise minus 35%, and the 1 year period it is 0. And the bank has gap limits as you cannot exceed 3-month cumulative gap, move beyond plus or minus 5%. In the 3-month bucket, you cannot have a gap compared to assets. Either way, you cannot move by more than 5%, plus 5% or less than 5%. You cannot have a long position or long assets or positive gap more than 5% of the assets, or you cannot have a negative position which is more than 5% of your total assets. In the 1 year also there's a gap or the limit, it should be within plus or minus 20%. But in this case you can see both buckets are in violation of these gap limits. There's a compliance issue. What you can do, to correct this position? How do you correct this? You have to bring down this to at least to 5%, minus 5%. This to at least minus 20%. How can you do that?
So increase the assets, so decrease the liabilities.
So in the shorter bucket, you have to narrow this gap. How can you narrow this gap? The answer has come like 100 minus 200. How do you narrow this gap? Either you have to increase this side or decrease this side, or you do the both. Manage the balance sheet from asset side or the liability side, or as a combination, what we discussed last week. Can you remember? We discussed in the liquidity management, we discussed you can manage it through asset side or liability side, or as a combination. So here you can do a combination of that, because it is not easy to switch. So how do you decrease liabilities? Can you ask depositors to, we don't want deposit, can you take out please? Can you make that request? No, you can't do that. Then they will never come back. So it's not easy. Can you give loans to customers forcefully? No, you can't do that. Even they ask, you have to do assessment and see whether it is feasible to grant that loan. If it is feasible, only you grant that loan. Just because of you want to rectify this your faulty here, you don't just go and generate assets. If you can buy some treasury bills or whatever securities and increase this, then it's fine. But then your interest income, you have to think about it as well. So likewise, it's not easy. However, this is the way that you have to do. Or there's one more possibility. Or use a derivative transaction like a swap. I think you discussed how do you do this in asset and liability management. So I'm not going to discuss that here. Just wanted to highlight this. These are the things that you have to consider, and by looking at this, you should be able to assess the impact on the net interest income. Say if interest rate increases at this point within next 3 months, what would happen? If interest rate increase only after 3 months, what would happen? If interest rate increase only after 6 months, what would happen? That kind of views for the assessment you may need. So if you have to assess what would happen after 3 months, then you should have some sort of a forecasted cap report, because you don't know what would happen to these assets and liabilities. These assets will be used to pay liabilities. Still there's a gap of 100. Then you have to generate new liabilities. You don't know whether those will be in this bucket or this bucket or this bucket, and maybe everywhere with different amounts. So you have to have a sort of a forecasted balance sheet and the cap report. Any question before we move into duration gap analysis? This is the income gap analysis based on the rate sensitive asset, or the gap report based on rate sensitive assets and rate sensitive liabilities. In the next one, we are going to discuss the impact considering the duration of assets and duration of liabilities. So to do this, you need knowledge on duration and how to interpret it and how to use it to calculate the changes for a given interest rate change. So any questions before we move into this?
So previously you said that even if the loans are in what you call variable rate, even in that situation also customer will do the pre-settlements. Can you explain that, sir?
Yeah. Say This is a loan for a 30-year period. And it's at a variable rate. Every year, assume for the simplicity, every year you can change the interest rate applicable for the next year. Assume at the beginning, interest rate is 10%. So you charge 10% for the first year. Then at the end of the first year period, you reset the interest. Say it's 8% going down. So you charge 8% for the customer for the second year. Here it's only 5%. Now interest rate is going down, so it's 5%. You charge 5% from the customer for the third year. Third year it's only 3%. You charge 3% for the fourth year. Again, this is going up to 5%. When you see this sort of pattern, oh, this is happening somewhere here, or maybe here. What do you think? Or what do you do if you are the borrower? Now you don't want to keep this change in environment into the future, because next year this may be 7%. Now you think interest rate again is going to go up. Do you want to pay 7% in the future, whereas you pay today only 5%? You try to fix the interest rate here. Maybe it may come as 7% or 6% or maybe 7%. But what's the period, remaining period? It's about 25 years. So what do you take? Why do you take a risk of increase in interest rate for the next 25 years? Even it goes back to 10. You have to pay 10%. Why don't you fix it at 6 and pay only 6% for the rest of the life? They will tend to do this if the market permits.
Yes, then there is no issue when the rate is decreasing, when issue is arising when the rate are increasing.
No, that depends. So because we never know what would happen. So what would happen depending on the penalty rate and things. So when it comes to 10 to 8, nobody would think about it of doing this, because there will be a penalty once you pay the penalty, and you fix it when the interest rate is 8%, and when you ask for a fixed rate for the another 29 years, you won't get 8%. Again, it will be close to 10. There's no real gain of doing this, so people won't do that. So but when it comes somewhere here, then they see this benefit. But as people greedy, at this point they won't do this. They will think no, interest rate will go down further and wait. So this happens, they think yes, I am correct, interest rate has come down, it will go further down and wait. Then it goes to 5%. Then what do you do? Now how do you feel?
Going for another option.
No, now what do you think? No, it was 3%. Say I should have fixed at that, and I should wait until this come back to 3%, and when it goes back to 3%, I'll do the fixing. Then it goes to 7%. So that human behavior would comes into play, but If you are a rational thinker, you have some generally somewhere here. We never know. That's why not 100%. Not everybody comes and prepay or borrow at a fixed rate. Only a portion will come and borrow at a fixed rate, depending on their knowledge, their behavior, their ability to borrow. Even at 3%, somebody may not be able to take a new loan from a bank. Their income level has maybe gone down. They're not in a position to borrow. So then they have to carry on the existing loan. Things, all those things comes into the picture. But this could happen somewhere here.
Okay,
Yeah.
thank you.
Yeah. Anything else? In the Sri Lankan market, these things are not that much happening, because even the banks discourage people to do this, and people are not that much aware of these things. And even first thing, what is the proportion of your loans are at floating rates in your banks, mortgages? What is the proportion at the floating rate? What is the proportion at fixed rates? So all those things matters. And in Sri Lanka especially, residential mortgages, how many or what proportion of people will sell their house and move into a new place, new area? It's not that mobility is not there that much, so we are sticking to one place. One thing is, country is small, and we are trying to come towards cities and things like that. But in other countries, they change their jobs frequently, so therefore they switch from one place to another place. So they settle even at the high rate. They don't want to keep the house because they are moving to somewhere else. They want to give it back to the bank and settle it and go to a remote area and buy a house there. So that dynamic is not in the Sri Lankan market. So if that dynamics markets there, these things can happen. So there are interlinkages. One market or product will develop because of the demand creating through a in another market. So when we have rigid real estate market and housing market and employment market, so everything would be mostly fixed. Then all those will add to costs as well. So cost is going up. No wonder happening that. Whenever you are not flexible, say small business, you are running a small business, you have 10-20 people work for you, but for say in this situation you don't have business, you cannot do the business, but still you have to pay the salaries for the your employees. But in other Western countries, no, you are out of the business or you scale down, you can fire the people, maybe with some compensation, fire the people, you cut your cost. So that flexibility there. Then now what would happen in ours? You have to pay, you incur a cost, you borrow, then the borrowing demand is high, therefore the interest rate is high. No income, then the default rates may be high. Things are happening. When you are not flexible, those are the costs added to the society. Anything else before we move into this? In any question? If you don't have any questions, so we will take a break here. And after the break, we'll start this duration gap analysis. During break, it's better if you can revise your knowledge on duration and related topics. If you don't have any questions, tell me what is modified duration. Before we move into manage interest using duration gap, just to remind you what is modified duration, how do you interpret it?
Your price change in your price for 100 basis point yield change.
Is it change in price?
Sorry, percentage change in price.
Percentage change in price. Okay. How do you write percentage change? So percentage change is change divided by the current price. Correct? Multiplied by 100, you get a percentage change. But the modified duration is percentage change of the price 100 basis point. So that means whatever the yield change for a given yield change, what is the percentage change in price? So this ratio gives you the, for a one unit of yield change, what is the percentage change in price? Correct? And what is the relationship between modified duration and Macaulay duration?
Macaulay duration calculates the weighted average time of return.
Weighted average time of return. Yes, fine. No, my question is that's the definition of Macaulay duration. My question is, what is the relationship Macaulay duration and modified duration? How do you derive modified duration from Macaulay duration?
Macaulay duration calculate the value of the change.
Value of the change
Of
not
interest rate of 1%.
No, that's what we discussed. Modified duration, percentage change in price for a 100 basis point of or the 1% of yield change. So that's given here. My question is, that's this is something important. So first you have to understand the question and answer the question, not something else. What is the relationship between modified duration and Macaulay duration? That is my question. I didn't ask what is Macaulay duration. I asked what is the relationship between modified duration and the Macaulay duration.
So modified duration equals to Macaulay duration minus Macaulay duration divided by 1 plus y k. Y divided by k.
Macaulay duration divided by Macaulay duration divided by 1 plus
y divided by k.
y divided by k. Okay, I just put y. What is that y divided by k? What is k? What is y?
Y market yield.
K.
K peak coupon frequency.
So in a bond, or if the interest rate is or the interest flows are more frequent than yearly, then we have to divide it by that number. So here we assume that is 1, k equals 1. So this is the relationship between modified duration and Macaulay duration. Modified duration equals Macaulay duration divided by 1 plus y. This is yield, or 1 plus interest rate, or whatever notation that you use. So then using this is the sort of definition of the modified duration, percentage change for a given yield change. So for a 1 unit of yield change, what would be the percentage change in price? So this is the definition. Once you write this way, you can derive a equation for a Macaulay duration as what? dp, or delta p divided by p divided by delta y, or everything multiplied by 1 plus y. So again, if you want, we can rewrite this as delta p over p, everything divided by delta y divided by 1 plus y. Same thing. So I just modify, I just write it as d duration. So that means Macaulay duration. We can write it like this. Duration can be written like this. So now you know what is this equation, and you know how to interpret modified duration. Okay, now go back. Is it clear now, this one? Any question on this? So this is the equation written here. Delta p over p divided by delta r over 1 plus r. Instead of y, I have used r here. R is the interest rate. And not only that, I have used that minus sign because duration is negative, directionally negative. If interest rate goes up, price goes down. Just to reflect that duration, this sign is given here. Okay, this is generally applicable for any asset or any liability, whatever interest rate sensitive instrument. So what I have written here is with this subscript A, just to denote duration. So whenever I say duration here in this today's session, it refers to Macaulay duration. Duration equals change in asset value of assets divided by asset value. So change in price divided by price. So since this is, I am going to refer to this to asset, change in asset divided by asset, and divide by the yield change ratio. We can try the same thing for a liability. How? DL equals delta L over L divided by delta R divided by 1 plus R. But we don't want that. We can find another relationship between asset and liabilities and get rid of that duration liabilities if we need. However, the same notation can be used. So this is the general formula without referring to any asset or liabilities. What is the Macaulay duration? This is the same thing with just specifying that this is the duration of asset. Clear? This is from the duration side. And last week, you may remember I discussed about interest rate sensitivity of assets and liabilities. Rate sensitive assets and liabilities. What would happen to the value of asset if interest rate increases? What would happen? If interest rate increases, value of assets, interest rate sensitive assets, what would happen?
Decrease.
Decrease. What would happen to the value of liabilities?
Decrease.
Still decrease. So because this concept valid, whether it's an asset or liability, it doesn't matter. Same concept. Value goes down when interest rate increases. And from basic accounting, I hope you have some idea. What do you call this equation? Fundamental equation of accounting or something like that. Asset equals liabilities plus equity. Correct? Am I correct?
Yes.
Yes. Asset equals liabilities plus equities. So then I use this delta notation just to mention the refer to the change. Whenever I say delta A, what does it mean? Change in asset, change in interest rate. Delta R, change in interest rate. So likewise here, delta A means change in asset value equals to whatever the change is, change in liabilities and change in equity. If this equation to be valid, that has to be there. Whatever the changes in liabilities and changes in equities, the sum should be equal to the change in asset. Otherwise, whenever the changes happens, this equation will not prevail. For that to happen, this is a must. Clear? Whatever the value change here and the value change in equity value together should give the change in asset value. But what would happen in value of what changes first? What happened? Value of asset changes and value of liabilities changes. Whatever the net impact will give rise to the change in equity value. So therefore, because can you remember, if you go back in these, I mentioned this bank capital. This is not rate sensitive. So this, whatever the interest rate change, this capital amount should remain fixed. But what would happen? Well, because of the changes in assets, changes in asset value and changes in liability values, whatever the difference will be reflected, added or subtracted into this capital. That's what could happen, no? Here. So therefore, we can rewrite this equation as change in equity equals to change in asset minus change in liabilities. Is it clear? Change in change in equity value is the net impact change in asset value and the change in liability or value of liabilities. Clear? Or any doubts? Any doubts, please? Or any questions? Or let me know whether it's clear.
So it's the balance sheet equation and impact would be the same across, no? That's what you are meaning here. The change would be same across assets, equity.
No. It's not the same. Changes may be different. So say if asset value increases by 10, it doesn't mean value of liability also increases by 10 and value of equity also increases by 10. It's not the case. Asset value changed by one amount, liability value changed by one amount, whatever the net impact would hit to the value of the equity. See this one, whatever the net impact of changes in these values, as change in asset value, change in liability value, whatever the net would be the change in the asset value. If this is a positive figure, this would be a positive figure. Equity value go up. If this is a negative figure, equity value goes down. Clear?
Okay, sir.
Okay. Anything else? Okay, just keep this equation as well. Remember this one. Now I'm going to get an equation for a change in asset using this duration equation. You know, how do you find the change in asset value? It is the value of the asset into the modified duration and into the change in yield. So you can see DA is the, I mentioned, DA is the Macaulay duration. Divide by 1 plus R. What does it mean? This is the modified duration. This is the change in yield. If you can remember, we had the equation like this when we discuss about duration. Duration impact as minus modified duration. Sorry. Okay, fine. And the price into change in yield. We had this equation. Can you remember? So the same equation here, instead of price, we have the value of asset. Modified duration, we have written here as Macaulay duration divided by 1 plus R, and the change in yield as change in R. So this gives you, for a given yield change and given the duration, what is the current interest rate, what would be the change in the value of asset. Same thing can be done for liabilities. Change in liability would be equals to value of the liability, duration of liability multiplied by the change in the yield divided by 1 plus yield, or the value of the liability into modified duration of liabilities into change in yield. So now we are going to combine these together into one equation. What is change in asset? What is change in liabilities? We can substitute these figures. In the next slide, you can see that. This is the change in asset. This part is the change in liabilities. So you can see delta R over 1 plus R is common. Take it out. Then you have minus dA into A. This minus times this minus becomes plus, minus into minus becomes plus, plus DL, I call it duration of liabilities, into amount of liabilities. Then we can take a common minus sign out. Then we can change the signs of these. dA times A minus dL into L. Duration into asset, duration of asset into asset amount minus duration of liability into liability amount into change in the rates divided by 1 plus R. So that will give us the change in equity. We can further modify this using this leverage concept. We know leverage is the liability divided by asset. Total liability divided by the total assets, it gives the leverage ratio. So instead of liability here, we can by dividing asset value, this equation dividing by asset value, you can, so I write it here. If you divide this by A and this by A and again multiplied by A, so then this will be cancelled out. So therefore this is the same thing, but A divided by A 1, L minus L divided by A is K. So we can write it as change in equity value equals minus asset value times duration of assets minus the leverage ratio into duration of liabilities into change in rate divided by 1 plus rate. So this gives us the sensitivity of, or the change in equity value for a given change in interest rates given the Macaulay duration of assets, Macaulay duration of liabilities, value of assets, and the leverage ratio. Or if you go one step back, what you need: value of assets, value of liabilities, duration of assets, duration of liabilities, and the rate changes. Then we can calculate what would be the change in the equity if interest rate changes for a given balance sheet with known durations. So this is an example. Assume you have set of assets in the balance sheet. Duration of those assets is 5 years.
Sir, excuse me, sir.
Yeah.
Can you go to fourth slide? That can you explain, sir, how that you replace those from that change of price?
Which one?
Change of assets and change of liabilities. How that came?
These two equations.
Yes, yes.
Okay. We have this equation. It's slightly different. Not a big no. notifications, we had this change in price equals minus modified duration into price into change in yield. Correct? We had this equation.
Okay, sir.
When we discuss at the time we discuss modified duration. Maybe notations may be slightly different. Whatever, change in value is the modified duration into the current value into the change in yield. So what I need now is change in asset. Okay. So for do that, what we need modified duration of assets into current value of assets into change in yield.
So in the first equation, I have it is multiplied by 100. Is
That can be done. That's to adjust the decimal places. That depends. If you that depends on whether you substitute these figures in decimals or as a percentage. That's the matter there. So
okay, sir.
remember how did we do there? Did we substitute as decimals or percentage? Say the duration. If we say duration is 7%, how did we substitute here? Whether we put it as 0.07 or 7. If we put it as 0.07, then we have to multiply it by 100. If we put it as 7, then we don't. Oh, something like that. So that's the concern. So like even earlier when I say percentage change in price, I just wrote it as this. But exactly to get a percentage change, you have to multiply it by 100. So we omit this part because these things will be cancelled out when you do division. That's why we omit that part. We took only this part. Like here also we don't want to use this into multiplied by 100. But only thing is you should be able to identify whether you should substitute figures in decimals or as a percentage point as it is. Okay, so that's why why I am telling you, don't just remember the equation. Then you should know how to substitute figures. What are these terms with some understanding. Otherwise, you cannot perform. You should know what is the meaning of this each and every this word or the notation. Is it clear now? That's the reason whether we use decimal points or a percentage point. So therefore, change in asset can be written as or can be derived by multiplying the modified duration by the value of the asset and the change in yield. What is modified duration? It's the Macaulay duration divided by 1 plus y. Others remains same. This is the equation used here, but instead of putting dA over 1 plus r, I have written here. That's it. You can write this as B into A into delta y divide by 1 plus y. That's fine. Or you can write B into A into delta y divide by 1 plus 5. Anything is okay. Same thing. There's no difference. Clear?
Okay, sir. Thank you.
So, excuse me, can you
Yes.
explain that? How did you include like leverage ratio, the previous slide?
Okay. What is our equation? Change in equity equals, there's a minus sign, dA into A minus dL into L into change in rate divided by 1 plus R. Okay. Can I multiply this by A and divide by A? Keep everything else remain same. So whatever in this, I put it into this bracket. Is there any change now? Is it the same thing?
Yes, it's the same thing.
Because A divided by A is 1. So same thing. Now I can take this A inside this bracket. Then I put A dA minus, sorry, dA times A minus dL times L divided by A, and the rest, this part goes here. Correct?
Yes, sir.
Yes. Okay, then I can break from this minus sign at this sign into two parts. Correct? If I take only with this within bracket part, I can write it as dA subscript A divide into A divide by A minus dL into L divided by A. Correct? This part.
Yes.
Break from this point into. So now A divided by A is 1. L divided by A is, what is L divided by A?
It's K, leverage.
Okay. So you substitute this part into this, then you get this equation. Clear?
Yes, sir. Clear. Thank you.
Anything else? Okay. Then what we have to do, use this equation to analyze our situation. Now in this case, duration of assets is given, duration of liabilities is given. But it may be the case in practical scenario, you may have to calculate or take each and every asset, interest rate sensitive asset, or prepare the cash flow with the timing and get the yield rates, discount it and calculate the duration. Or you calculate the duration of each and every asset separately, then calculate the weighted average of duration to get this figure. Either way you have to do this. So here it's given, however, Duration of the asset is 5 years. Duration of the liabilities is 3 years. Interest rate are expected to rise from 10% to 11%. So what is the change in rate? What is the change in rate?
1%.
1%. And remember, it's positive, because 10% to 11%. 10 to 11. Then the change in rate is new rate minus old rate. If it was other way around, then it is 10 minus 11. This would become minus 1. So however, here it's positive 1%. These are the things that you have to remember. Just don't use just 1%. See whether it's a plus 1% or negative 1%. And the balance sheet is given. Total size of assets 100. Total amount of liabilities 90 and equity 10. What is K? L over A, which is 0.9. Correct? Is it correct?
Yes.
Okay. Then we'll see when this happened. Interest rate increased from 10% to 11%. Now you know what would happen for the value of assets. What would happen to the value of assets?
Should decrease. Huh?
Should decrease. Can you tell me what would be the new value? What would be the new value of assets once interest rate increases? How do you calculate that? What would happen to the value of liabilities? What would be the value of liabilities? New value of liabilities once the interest rate increases.
It should decrease.
Huh?
It should decrease.
Decrease. So it should decrease as well. Okay. What is A new? That means value of assets now after the interest rate increase, and what is L new? Can you tell me? Durations, Macaulay durations are given. Current interest rate is known. Change in interest rate is given.
It's 95.
Which one is 95?
Asset.
Asset 95. Exactly. What is the L new? What's the amount of new liabilities?
$87.3.
80.
7.3. I'm not too sure.
87 point.
Sometimes correct me if I'm wrong.
Yes. I don't know whether these are correct or wrong. We'll see. Any other answers? Different answers? Direction wise correct. Both figures are lower than the original figures. So that side you have done it correctly. Whether the figure is correct, let's see. Okay, assume these two figures are correct. Now, to be in line with this equation, so it's always true, no? Now, what would be the value of equity? What is E mu?
$7.7.
7.7. That is true given these figures are correct. Huh? Then what is the change in equity?
2.3.
Huh?
2.3.
2.3.
3.
But minus, correct?
Yeah.
Okay. If you calculate this as a percentage of this 10, divide by 10 into 100. It would give you 23%. Correct? Okay, let's see. Somewhere close. Change is only 2.09 million, where you got 2.3 million. So we'll come back and see whether these figures are correct. If you just straight away use this, as I mentioned, K is 0.9. This is the asset size 100 A. What is this 5? That is DL. What is this 9.9? It's K. What is this 3? Sorry. What is this 5?
DA.
DA. So why didn't you correct me? This is DA, duration of assets, duration of liabilities. So can someone try this in a calculator and see whether it's correct? Then change in yield is 0.01 because it's 1% and divide by 1 plus 1. Once you solve this, you should get minus 2.09 million. I think my calculation is correct. Is this correct? Minus A into dA minus A L over A into dL into change in yield 0.01 divided by 2.09. Correct? Is it correct? Any question? Any question? This 2.09, is it correct? Did you all get it? Or are you still working on it?
So this answer is correct, but the amount is given is a Macaulay duration at 5 and 3 are Macaulay duration, not modified duration.
Yes, Macaulay duration.
So we have to find that modified duration.
No need once you put it into this equation, because this 1 plus r will convert that Macaulay duration into modified duration. That's why. Oh, same equation you can write it as minus a modified duration of a minus k times modified duration of L into delta R. Same thing. Clear? Is because Macaulay duration divided by 1 plus R is the modified duration. Macaulay duration divided by 1 plus R is the Macaulay duration of liabilities.
So
Correct?
we take R as 1 here.
R is not 1. What is our current R in this equation? What is the current yield? What is the current yield?
So 10%.
10%. So then 1 plus 1 plus R
1.1.
1.1. So this is 1 plus R. R is 0.1. So
Okay.
this becomes 1.1. Any question? Is it clear now?
So, but why did you get that wrong answer here?
Previous case. This one.
Yes, what we said was
Yes.
incorrect.
Now you can think about what is the mistake that you have done. For me, this is not 95 and the other one is not 87.3. So this is the calculation. What is the change in asset? Asset size into Macaulay duration into yield change divided by 1 plus R. So it should give you 4.540556. Then it should be 95.44. In the yield, in the liabilities also, liability amount into Macaulay duration 3 into yield change is 0.01 because it's a 1% change divided by 1.1, 1 plus 10%. So it should give you 2.45. So these are the new figures, value of assets and value of liabilities. So this is the value of equity. Now if I convert this into so the change in equity, you should get this minus this 2.090. One maybe you have done a round off here, that's why you get 95 here. 87.54, I don't know how do you get it as 87.3. So I think
Can you
this,
go to that Excel again?
I think with this now you have a better understanding what is this exercise, whole exercise. Instead of calculating what is the change in asset value, what is the change in liability value, and then calculate the change in equity value and convert it into a percentage, or just to calculate the change, we can straight away calculate what would be the change in equity.
Sir, can you show that formula to change in assets?
This one.
Yes. So why do we divide it by 1.1? That's the mistake, I think.
Again, what is the how do we calculate the change in price or the value? What is the equation we have?
So that's okay. So okay, that's included there.
That's again the duration given is Macaulay duration. You have to divide it by 1 plus R to make it a modified duration. Clear?
Okay, sir. Thank you.
Now you know my assumption. What is my assumption or the inference here? Other than who is asking this question, all others have done this correctly. So I'm so happy. I think it's correct. Otherwise, you should ask questions. Am I correct? Now, someone, the person who gave me the answer for asset liability is 87.3. Now you can tell me what went wrong. Why did you get 87.3? Those who got 95 can tell me why it is 95. How did you get that? What is the mistake that you have done?
We didn't get that change of that. We didn't use the change. Not divided by 1.1. Only the.
We took only the R, directly the yield.
By 6.01.
Yeah.
Okay. Is it the same reason for the 95 and 87.3 both? Let's see. No, it can't be. Here also that can't be the case. You get much.
No. Divide by 1.1. No, so that should be 1, is it? We got the rate change correctly, I think. 2.01 was correct.
Correct. But you didn't change. Divide by 1.
Divide by 1. Just divide by 1.
Yes.
That's the problem.
How did you get that one?
Now our answer is correct.
Instead of using the modified duration, you have used the duration. Okay, is it clear now? So why did you do all these things? So now you can see what for interest rate changes, this is indeed the economic value. What would happen to your equity value when you have this balance sheet and interest rate increased by 1%? Value of your equity goes by 2.09 million. If these are in in millions, so your equity value goes down. That means basically you have incurred a loss. If the interest rate decreases, you earn the same thing. Instead of a 2.09 million loss or drop in equity value, it will be an increase in equity value. So That's the concept. So few words, this part dA minus KDL, that part is we call the duration gap, or not just duration gap, leverage adjusted duration gap, because dA minus K times DL. But remember, this is in Macaulay duration, not in modified duration. Correct? So what would happen if this gap widens? Positive gap widens. What would happen? If these gaps widen, that can happen either due to duration of assets increase or duration of liabilities decrease, or increase in K or decrease in K. In increasing, this would be widen if duration of asset increases, correct? Or duration of liability decreases, or simply if the whole term decreases, this difference would be widened. So that can happen either DL goes down or K goes down. So what would be the repercussion if this gap widens? If interest rate increases, your loss would be high. If this narrow, then it would be low. But if this gap becomes negative, then the interest rate increase would generate increase in equity. So summarize here. Effect, if the gap is zero duration gap, that means there is no impact to the equity. You can see here, if this becomes zero, the whole multiplication becomes zero. Change in equity is zero. And remember, this term does not equal to zero when dA and dL equals. dA equals dL. This won't give that gap equals zero. This is would not happen. That will happen only when dA equals K times, sorry, dA equals, yes, K times dL. When this happens, delta E is zero. All other times there will be an impact on the equity. When you have a positive duration gap, interest increase, equity decrease. Whenever you have a negative duration gap, interest increase, equity also increase. That is the ultimate result. Any question? That's it. May I start this one, or do you have any questions? So in the market risk, I mentioned that there are two main topics that we are going to discuss. One is interest rate risk, and the other one is the foreign exchange risk. So we are going to start foreign exchange risk. We covered interest rate risk. On the interest rate risk side, there's a small thing. We discuss only about the interest rate sensitivity of the net interest income and the value of equity. But there are different some other concepts as well. So like if you have a portfolio, you don't have liabilities, you just have asset only. um, you want to maintain it. How do you do? Or on the other hand, if you manage a portfolio like a pension fund or something like that, how do you do that? How do you manage your interest rate risk? So there's a concept called immunization. So how do you do that? I'm not going to discuss that, but in simple terms, immunization means, so in what we did earlier, the impact is zero. There won't be any change in equity due to changes in interest rates. There won't be any change in equity because change in asset value and liability value will set off each other in such a way there won't be any impact on the equity. So that is the base. That's what basically implied by the immunization. So but that concept can be applied in different places in different manner. When you have asset only portfolio and asset and liability portfolio, with there can be some say like in a pension fund, you have assets well as liabilities, but there's no equity per se. So then how do you do that? So these concept I'm not going to discuss over because it is time consuming and it's not relevant for a treasury, I would say, especially in a bank. So therefore we are not going to discuss that. So any question? If not, we'll go into foreign exchange risk management. And again, I think now you can remember foreign exchange related concepts that we discussed. I'll give a brief introduction and what are the foreign exchange exposures that we can have, how then managing risk.
Excuse me, sir.
Sorry, yes.
Excuse me, sir. Sir, in case of that, to make interest rise, so interest rate going down to make that impact as negative. So duration of both assets and liabilities should be equal, right?
In which case?
Any case of say without equity. Then
without equity, yeah, okay. Then there's only asset and liabilities. Fine. Then what is your question?
If to make that impact zero with regard to increase of or decrease in interest rate, its duration should be both same, right?
Same, yes, because what is leverage? It's one.
Yes.
LOA equals one. So then duration of asset should be equal to duration of liabilities. That's exactly what they do basically in a pension fund management, especially when there's a defined benefits. If you say you know what is the amount that you have to pay when a person retires, it's not whatever the fund available, but it's the given amount that you have to pay for that person. Then there's a given liability. So in that you have to assess the duration of that liability as well as duration of your assets, then match together. Then there won't be any mismatch. Otherwise, value of the fund may not be enough or adequate to pay the liabilities, there will be a gap. Then the fund sponsor may have to fund that deficit, providing excess cash. So in Sri Lanka, we don't have, as far as I know, there won't be any such pension funds, but that can applicable for insurance up to some extent, depending on their policy, because there are life insurance. Some are very close to pension fund.
Okay, sir. Thank you.
Anything else? So shall I move?
Okay, sir.
So, so basically, in any organization or any entity or any individual who does business with or customers with outside or foreign parties exposed to foreign exchange risk. That's the basic idea. But when we move forward in few slides, you would see even someone who's not doing business with any foreign party, still there will be a impact, exchange rate impact on their business. We will see that in a moment. So these are some of the extractions from some of the very famous firms in the world. So they all worry about the exchange rate because maybe bulk of their incomes coming from overseas subsidiaries or partners. So they have to worry about the exchange rate risk. So these are some of the statements or the what do you call notes given in there, some of their annual reports. Some of them may be quite old now. Here what I'm trying to explain you, why do we need this, or how this exchange rate changes and what are the repercussions. This is just dollar rupee exchange rate. This is a little bit old, up to 2014. So you can see from 2005 to 2014. So there were sort of gradual depreciation, then sudden appreciations, again sudden depreciation, gradual. So again an appreciation, going flat. If you go back, you can see what are these regimes, what could have happened. So this is just after the tsunami appreciation. What happened until 2006? It was gradual, on a gradual depreciation. But again in 2006 there was a sudden appreciation. Then again sudden depreciation and maintains. In 2008 it was flat. So but again in 2011 it was a sudden jump. If one can remember what is the reason here. Can you remember what happens on this date?
World Trade Center hit.
2011
Sorry, sir.
November. This is dollar rupee, and rupee depreciates. This is the date on which Finance Minister of Sri Lanka in his budget speech let the depreciated the currency by 3 rupees. This is the immediate impact. Then what happened? Central bank stop the intervention or the control of the market volatility. So central bank step back, and this is the result. End up in 135. Then again, central bank took some actions, brought it back to 125 level, stabilizes there. But then again, it went up. Now it's, you know, where is it now? So however, what I wanted to show you, see, there can be very stable exchange rates or maybe volatile or trend in market. We call trend because it's a slowly downward. Here slowly upward, gradual upward or gradual downward. Then the predictability is there. Here also predictability is there. Then it's easy for someone to take a decision. But things like these unexpected events that will disturb the markets, that will introduce you the risk. This is a daily exchange rate graph in dollar rupee, but this is euro dollar exchange rate daily. You can see what is the fluctuation. You don't see a flat line nowhere like here. No clear trend other than this section. So even within that, lot of ups and downs. So the foreign exchange market is the one of the most volatile market in the global financial markets. So it varies every second or millisecond. Very difficult to predict. But that, again, that depends on your time frame. Whether you think about a within a day transaction or a few months, few years. If you see within this period, 2005 to 2014, beginning to end, there's not that much change. If you compare the exchange rate here and the exchange rate here, it is the same. Whatever the volatility here, you don't have to worry if you think in the long term time frame. But if you think in the short term, then these are the movements that you have to worry. This is another currency. This is yen. Again, you can see volatility, and it went down until 2011 end. Then it's again started to depreciate. So these things can happen. This gives you the risk when these things changes very frequently. This is the euro dollar exchange rate, tick by tick. That means within few days each movement. So whenever the exchange rate change, what it is. So even within very short period, you can see a lot of volatilities within seconds also. So it's highly volatile market that will give us the exposure to exchange rate risk. As I mentioned earlier, there are few types of exchange rates risk that arise for a party or organization or an individual, depending on what you do or what is your business style or things like that. So there are broadly mainly three types of exchange rate risk. We call them as transaction exposure, translation exposure, and economic exposure. These three exposures will give you the exchange rate risk. If you have any of these exposures, then exchange rate will give you a profit or a loss, or will have an impact on your business or day-to-day life. We'll start with one by one. Transaction exposure. What does it mean by a transaction exposure is like, say Sri Lankan exporter say tea exporter has entered into a transaction with a German party or a Russian party to sell 1 metric ton of tea. One metric ton of tea. The price is, in which currency we price tea. Say price of 1 kilo. Say it's two US dollars. That's the price that the Sri Lankan vendor or the exporter agrees with the Russian party. Then what is the process? Can someone tell me what would happen? When a Sri Lankan exporter agrees to export tea, price is $2 per kilogram. The quantity is 1,000 kilogram. You just enter into that agreement. Then what is the process? Most of you are bankers. You should know. How do you do this transaction? How do you settle these? Can someone explain the process?
The exporter will come to an agreement with the bank to sell his dollars on his receipt on this date at this much. He will come to agreement.
If we put this into a timeline, time 0 on this date, this is the agreement between the buyer and seller of tea. That means Sri Lankan exporter and the Russian importer. Then what would happen? Then what would happen?
Here open an LC.
Who has to open an LC?
The buyer, sorry, seller, right?
Seller. Sorry, here I did a mistake because buyer is the importer, seller is the exporter, isn't it? This is the Sri Lankan party.
Yeah.
This is the Russian party. Okay, who opens the LC?
The person who's importing, the person who should be paying, right?
Yes. This buyer will open a LC. When? Maybe on the same date. Then, meantime, is anything to be done by the exporter, Sri Lankan exporter? Have you done any trade finance course at IBSL? Any one of? Okay, what is the process?
So the seller would have to go to his bank and make some arrangement to contact the buyer's bank, right? Probably.
Mm-hmm.
Or a correspondent bank.
Yes, probably I think Sri Lankan seller would inform the buyer, this is my bank, send the LC to that bank. So Sri Lankan correspondent bank will receive the LC somewhere here. But meantime, will the seller wait to make the shipment until he receives the documents? Yes or not?
Yes, sir.
Yes. Okay. So say this took about 2 weeks. Okay, 1 week. Then only the tea is shipped in a ship. Then once this is done, again the document should be sent to the buyer. Correct?
Yes,
Whatever the shipping documents, the
To the bank.
sent to the bank in Russia for the correspondent bank. Once they receive this document, depending on what sort of LC, whether it's by receiving, seeing the documents you receive,
Sites.
yes, term of site, or there are different ways depending on what which they will make a payment. So, however, there will be a counter. Correct? The
Yes.
the buyer won't receive, sorry, seller won't receive his proceeds today or the at time zero whenever the seller, buyer and seller comes into that agreement, or there may be a credit period. If you have a good relationship, you will ship the goods and give the buyer a 1 month or a 3 month credit period. They will pay it. So what would happen today exchange rate is 200 per dollar, and the seller will receive dollars on this date. What is the risk?
Exchange risk there is.
Exchange rate risk. Whether the
Both
exchange
ways.
rate
Whether
appreciation or depreciation.
yes.
No, what? Whether it's appreciation or the depreciation.
It's appreciation.
It's appreciation. That means if this comes to 180, by the time the exporter receives dollars, he get only 180 rupees per dollar. But he did the pricing maybe based on this 200. So he will face to a, or he will incur a loss. However, forget about that whether it's a loss or profit. However, due to a transaction that you have already entered into, you will get exposed to a exchange rate risk. Correct? That's the basic idea. You entered into a foreign exchange transaction and you are about to make the payment or receive money. So therefore, you get exposed to the exchange rate risk. That is what we referred as transaction exposure. Is it clear? You have an outstanding transaction with a party either you pay foreign currency or either you receive foreign currency, then you face the exchange rate risk. That is with transaction exposure. Any question? So that transaction can be as I mentioned, imports of goods, so import or export of goods or services at a agreed price, or maybe a borrowing or lending in foreign currency, whatever transaction. But at the time of the transaction and until you make the or settle the transaction and you get or you pay money, you exposed to the exchange rate. So that is we call transaction exposure. Then the other one is translation exposure. What does it mean? Say the same exporter has granted a credit, 3 months credit in November. So then he will expect to receive that funds in February, correct? Correct. Say the amount is $200. Sorry, $2,000 because $2 per kilo, 1,000 kilos, $2,000. Now, Sri Lankan exporters balance sheet as at December 31st. How do you reflect this credit facility?
So as a receivable.
As a receivable. What is the exchange rate that you use to? Because do you reflect it in dollars or how do you express in your balance sheet? Sri Lankan firm.
It will be in rupees.
It should be in rupees. How do you decide what is the value of that $2,000 in terms of rupees?
So as of that accounting year, December 31st.
Yes, whatever the exchange rate prevailed, this is only one way. There are different methods of the current translation method and things like that. There are 3 methods to convert. I'm not going to explain it. Simply assume you use the exchange rate prevailed on this date. So if it is now 199, what would happen? So here at this date it was 200. If you prepare the balance sheet on this date, it was at 200. Now it is at 199. So this is not that the trade impact. This is the translation impact that you have. So this example would be ideal if I extend this for another year. Assume this is a long-term balance sheet item. So this is 2020. This is 2021. So on this date, you convert it at 199, but still this is in your books. When do you convert the same amount as at 31st December 2021? It would be at another exchange rate. It may be 205 or something like that. That depends. So, however, due to these exchange rate changes, your balance sheet items which have foreign currency component will change in rupee terms. That is we call the translation exposures. It can be through assets or it can be through liabilities. So however, this we call them paper losses or gains because this is just the reflection in the balance sheet as unrealized. You will realize whatever it is whenever you settle the transaction, whenever actually you pay or receive and convert it into rupees. Until such time in the balance sheet, the same $2,000 will be shown in different rupee amounts. So if it is an asset, if the rupee amount increases, it's good. If it decreases, it's not good. But if it is a liability, if the rupee amount increases, it's not good. If it decreases, it's good. So likewise, that also the existing position in foreign currencies will give you exchange exposures at the time of translation. That means when you reflect it in, when you are going to revalue to reflect it in the balance sheet. So that sort of risk we call the translation exposure. Then the third one is the economic exposure. For that, I'll take a example. Say assume Sri Lankan firm. There's a Sri Lankan firm who produce, say, rubber product. Say just say okay, just rubber balls. Okay, he producer, Sri Lankan producer, the manufacturer, he does not use anything outside from Sri Lanka. He does not bring any raw material or any chemical or anything, nothing. Oh, say 90% is domestic, nothing imported, which is used for his production, and nothing exported. Whatever the he sells in the domestic market. So all the cost he bears in rupees. So no exchange rate risk there. So all the products he sells in the domestic market. So no exchange rate there. Just in rupee terms, whatever the labor cost, raw material cost paid in rupees, whatever the income generate through sales in rupees, whatever the difference is his profit. But assume product, there's another party in Sri Lanka, the same product, that party imports it from China. Then there's a competition between two firms. Okay, then what would happen if the rupee exchange rate appreciate and depreciate? What is there any impact on the local manufacturer if this exchange rate changes? Say he is selling a rubber ball at 100 rupees. The competitor also selling at 100 rupees. The US dollar LKR is 200 rupees. This is the local manufacturer. This is the importer. What would happen? Exchange rate goes to 220. What would happen if it goes to 150? This is a very good concept that you have to understand. What would happen?
In the depreciation scenario, that local manufacturer has an advantage if we
Yes.
use the raw material purely from Sri Lanka.
Yes. In this scenario, when the exchange rate goes up, what would be the cost of importer? Now, for a $1, he can buy 2 balls. Correct? 2 rubber balls or whatever, 2 units. But when it goes to 220, he can buy 1 something. So that means his cost increases, but generally there's no reason for him to increase his cost, because he buy everything from the domestic market. So then he has the advantage. The importer may try to sell it at a higher price. So either the local manufacturer can grab his market share or increase this price and take more profit. So there will be an impact on this business, though that business does not have any foreign currency element. What would happen if the exchange rate goes to 150? Now for the importer, his cost in rupees is low, it's cheap now. He can buy 2.5 units instead of 2 earlier. He can sell it at a lower rate. But what would happen to the local manufacturer? His rupee cost would be still the same. So whatever the share of this local manufacturer will be taken over by this importer. So he will lose his business share or the profit. If he can reduce the price and sell it, match it with the importer, it will reduce the price. So that kind of exposure we call it is the economic exposure. So as an economic agent in any country, we all face this exposure directly or indirectly through transactions and others. So that's what happened. Now the food for thought, what should be the exchange rate of Sri Lanka? Should it be at 100 or should it be at 200 or 300 or 500 or 10 rupees? Think about it. Okay, any questions? And the other thing is, exchange rate is not the only factor for these things. the quality has to be matched. So we should be able to produce at the low cost, whatever the exchange rate. If this is still cheap, it is worth to import than producing here. So these are the three exposures: FX risk, transaction exposure, translation exposure, and economic exposure. Next week we'll mostly discuss about how to mitigate exposures into, or the risk arising due to, transaction exposures and translation exposures. Economic exposure, that cannot be done purely or the only through the financial market transaction. It is mostly a business and strategy issue. That's how you should handle this. So therefore, I'm not going to discuss how to mitigate your economic exposure, but mainly we'll focus on transaction exposures and translation exposures, because especially in Sri Lankan, you may have to advise clients as well how to mitigate their exposures due to their transactions with, or arising through their transactions with foreign parties. That is there. Sometimes even the translation exposures you may have to hedge or give some advice and do some offer some products for them to mitigate their risk, your client. So therefore we'll mainly focus on transaction exposure and translation exposure and discuss how you can minimize the risk arising through transaction exposure and translation exposure. So with that, I'm going to stop here today. If you have any questions, you can ask.
So this translation risk happens only be report that in the financial reports, no? If not, it will not report it. No?
You have to report your positions in your financial statements. Otherwise,
Yeah, it does not happen
yes.
that with the estimation it is done in November, but it is within the course of year. It won't happen.
Sorry,
It won't reflected in the statements. So
I didn't get.
in the example you mentioned that it is happened November and reported in December, but transaction happens in next year, so it reflected in the state. We have to reflect in the statement, but if it happens within the financial year, it won't be reflected. Right?
That yes, it won't be there, but that depends on the but what yes, that difference will go through the transaction exposure, hit your P&L, and that depends on how frequently you prepare your balance sheet or report it, whether it's quarterly, annually. I just took the annual example. Nowadays theoretically it's daily, at least quarterly. So then it will be there. If cross over a quarter end, then it will be there.
Okay, so thank you.
Yes. Anything else? Okay. If you don't have any questions, we'll stop here and we'll continue with this next week. Okay. See you.